What is up, traders? On your screen, you see F times S equals W. F minus W equals L, W minus L equals G, and G times R equals ROI. What in the hell does this entire formula mean? Well, this formula will give you everything you need to know to come up with an overall expectancy of any strategy. It will change the way you look at strategies and trading forever. And after the intro and disclaimer, I'm going to dive into some major detail about this formula. And by the end of this video, you're going to know the steps you need to take to stop losing money in the markets and to start becoming a professional trader. We're also going to do the analysis that we always do on the top 5 major pairs. I'm going to give you guys my expectations on those at the end of the video, so make sure you stick around to the end. Make sure you click that subscribe button if you want to be alerted about the videos we come out with just like this every single week. Click that like button for me while the intro and disclaimer roll, and I'll see you guys directly after. Welcome back, traders. So here we are with this formula in front of us. We're going to dive right into it right now. First thing we're going to do, we're going to take a look at this formula. We're going to talk about what S, R, and F stand for. This formula is going to give you the ability to take a very mediocre strategy and turn it into something that can give you a massive return at the end of a year. And I'm going to show you exactly how to do that and exactly what I'm talking about right now. So let's first start off with the triangle you see on your screen. These are the 3 things that go into your overall expectancy or your expected outcome of any trading plan. This S stands for strategy. The R stands for risk, and the F stands for frequency. These 3 things will be everything you need in order to get an expected outcome of a strategy, and not only to get that expected outcome, but to manipulate it in a way where you can take one of those mediocre strategies we just talked about and turn it into something that gives you massive amounts of profits by the end of the year. And I'm going to talk about exactly how to do that again right now. So for strategy, we're going to go this way with strategy. Traders come into the market a lot of the time expecting to find the unicorn of strategies, expecting that in order to profit in the Forex market and in other financial markets, they for some reason need to win 90% of the time or 80% of the time with a huge risk to reward ratio. But let me give you a different expectation, and what in my opinion is the correct expectation. Because with that high of an expectation, with looking for a unicorn and all you ever see is regular horses, you're going to be disappointed a lot in this market. So as a good expectation for you to try to achieve some of the best strategies I have ever created in the 8 years I've been doing this, have won at around a 60% accuracy with a 1-to-1 risk reward. That should be a 1. Sorry about that, guys. With a 1-to-1 risk reward ratio. So with this being the case, what this should tell you is that you don't have to have that unicorn of a trading strategy. Again, some of the best strategies I've ever tested on average come out about 60% accurate with a 1-to-1 risk reward. Now, in terms of risk, let's move on. Risk, and don't worry if you're getting a little bit confused, we're going to go over all of this multiple times to make sure you completely comprehend it and to make sure you have a practical application for it to help any mediocre strategies you come up with turn it into the unicorn of trading strategies in a sense by the time you're done manipulating this formula. So looking at this strategy, again, most traders are looking for the unicorn. Would you call 60% accurate with a 1-to-1 risk reward the unicorn of a trading strategy? No, this would be more like a regular horse, right? Might even call this a llama or something like that, or a goat. So this isn't necessarily the best trading strategy in the world, but let me show you what you can do with it. With this 1-to-1 risk reward, let's move on to risk now. Risk, we're going this way. Risk, for me, I normally do between a 1 and a 2% risk per trade on my total account value. So let's do a 1% in terms of risk. 1%, and what we do is risk per trade. I'm going to label that RPT. From now on, RPT means risk per trade. Now, 1% risk per trade. We're moving on now to frequency. What do you think frequency means? It means the amount of trades you're going to take per month. In this entire equation, we're doing this on a per month basis. So frequency is the amount of trades you make per month. And what we're going to do here is we're going to say that you are a swing trader, someone that's trading on, let's say, a 4-hour time frame. And with that being the case, the 4-hour chart gives you 20 trades per month. 20 TPM or trades per month. This right here is all you need in order to come up with your expected outcome per month, which is going to be right here once we get done with the equation. So the reason we have all of this written out, the reason I wanted to show you this, is because we can take the equation you see to the right hand side of this triangle, and what we can do with this equation is actually come up with the exact expected outcome per month you could get if you had a strategy that won 60% of the time with a 1-to-1 risk reward. You had a 1% risk using that strategy per trade that you took, and you were on a 4-hour time frame making about 20 trades per month. With that being the case, we're going to use this equation to the left of this line that I'm drawing right now. We're using this equation, and we're going to come up with your actual expected outcome per month using this strategy. So F is going to be frequency. What did we say frequency was? 20 trades per month. So F, or frequency, is 20. We do F times the strategy, which is 60% accurate. So it would be F times 0.6. That's going to give us 12. So we have 12 wins. Now what we do, or 12 W, now what we do is we take F again, 20, take our F, we subtract those wins, and we get 8. 8 is going to be our L, our losses. We then take wins, which were 12, we subtract our losses, which were 8, we end up with 4. Now, 4 is our G, or gain. 4 is the gain that we get with this exact system, this exact strategy and trading plan. We get a 4 gain on that. We take our gain, which is 4, and we now multiply that times R, which is our risk, which would be 1%. That means a 4% ROI, because gain times risk gives us our overall ROI per month. Now, right here, 4% gain per month. A lot of traders would look at that and go, shit, that's not enough. But some of the best traders in the world hit around these types of numbers. And let me show you why that's important, even without money management. If I do a 4% gain for 12 months, let's do 4% over the full year, I end up with a 48% return. A 48% return is a great return, especially if you're starting out, especially if you're only having to trade 20 times per month, especially if you're swing trading on a 4-hour chart. That is incredible, right? 48% return is awesome, and you can add 10 to 15% to this if you're going to use a good money management plan. If you're using a good money management plan, it'll add to this about 10%. That is a 58% return overall on the year. Again, using a mediocre strategy. Now, what I was talking about earlier is how we are going to not only use this formula to get our expected outcome, which in this exact formula would be what? 58% a year, or 4% a month. Without money management, 48% a year. What we're going to do now is I'm going to show you how to take a mediocre strategy, a 60% winning ratio with a 1-to-1 risk reward, and we're going to change this into something that can give us a maximum, a huge amount of profits over the course of a year. This is something I've done in my trading the entire time. And what we have to look at in order to do this is the factors of this equation we can change. Can we change the strategy? And this, of course, you can change the strategy, but that, for one, takes a massive amount of work. 2, you have to test a whole new strategy. What we're going to do is we're going to keep this as the constant. The constant is going to be the strategy, meaning we're not going to change the strategy whatsoever. We don't have to do any more back testing. Well, we may have to do back testing depending on what we're going to change in the other parts of this equation, but we don't really have to create a brand new strategy now. Okay, so no more creating a brand new strategy. We have a 60% chance to win, a 1-to-1 risk reward. What are factors we can change though? Well, we can change the risk, right? What if we took the risk from a 1% risk to all of a sudden a 2% risk? Instead of doing all this math over and boring you, if you want to, you can absolutely take this equation and plug in a 2% risk per trade for yourself to see what that does. But I can already tell you what it's going to do is double the return, obviously, right? So with a 2% risk, let's just do our 4% because that's going to stay the same. Our constant is still going to be 4. So we're going to do 4, and we're going to multiply that now, instead of by 1%, by 2%. If we do that, what does that equal? That equals an 8% return. If we multiply that by 12, now all of a sudden we have this very simple strategy that gives us 60% chance to win with a 1-to-1 risk reward that we're trading on a 4-hour chart that's giving us 8% times 12, which is a 96% return overall over the course of a year. Being able to do that, being able to make 96% in a year will put you in a top 3% of the top 5% of traders around the world. So creating a system and being consistent to a system that has a 60% chance to win with a 1-to-1 risk reward with a 2% risk can create a massive gain over time. Now what we're going to do finally, and one last thing I'm going to take you through and we're going to look at after I delete every bit of this, is going to be one more thing that we can change about this specific system, this specific trading plan. We can also change not only the risk, so we'll keep the risk the same, but instead of just changing the risk, we're also going to have an opportunity now to change the frequency. What do I mean by that? Well, what if instead of on a 4-hour time frame, you probably need to do this if you have a full-time job. The 4-hour time frame is a time frame where you can capture most trades if you have a full-time job. Maybe every trade, even if you have a full-time job. But what if you get to a point now where you're capable of trading on a smaller time frame? Do you think your frequency is going to go up if you trade instead of a 4-hour chart on a 1-hour chart? Well, of course it will. Yeah, so we'll change the frequency now to a 1-hour chart, and let's say instead of getting around 20 trades a month, we ended up getting 60 trades a month. So now we have a 1-hour chart. We have 60 trades per month on this 1-hour chart. So we're going to plug all this into the equation again. And what I'm going to show you is even with this, remember, we have not changed the strategy. We still have a strategy that has a 60% chance to win and a 1-to-1 risk reward. And the reason I'm showing you all this is so you know that you don't need that unicorn of trading strategies that wins 90% of the time. On your process of creating and testing strategies, you are going to be frustrated a lot. But when you find something that can give you like a 60% chance to win, that can give you a 1-to-1 risk reward, don't discount that as a mediocre strategy, because the things I'm showing you in this video can take that mediocre strategy and turn it into something that can create a massive return at the end of the year for you. So right here, let's redo all of this, and obviously our expected outcome is going to change dramatically now, because what we're going to have is F times S. Our frequency is now 60 trades per month. So what we have is F times S. So we have 60 times 0.6, which is going to equal 36. 36 is the number of wins we're going to have. Now we have to do 60 minus 36, or F minus W, which is going to give us our losses, which is 24. We have to then do wins minus losses, which is going to be 36 minus our 24. This is going to equal our gain. What is 36 minus 24? That is 12, right? And since we have 12, what we're going to do is keep our risk the same as we did. Our risk down here is going to stay at 2% risk per trade. So if we have 12 as our gain, we multiply that by 2%, and we put that number right here. That means that we're going to have, if we keep the strategy the same at 60% with a 1-to-1 RR, we are capable on a 1-hour chart with around 60 trades per month, and this may have to be 15 minutes, but again, let's go to a day trading time frame. We're just upping the frequency of trades, but overall, with 60 trades per month and the same strategy, we have the opportunity to make 24% per month, which, by the way, guys, multiplied by 12 is a 288% per year ROI. If you can create a 288% ROI per year with a decent drawdown, you are going to be one of the most elite traders in the world. And all of this did not come from some kind of unicorn of trading strategies, but rather a strategy that wins 60% of the time with a 1-to-1 risk reward, with one target and risking a plausible amount, in my opinion. At least I'm okay with risking 2% per trade. Your risk is obviously determined by your own risk tolerance. For me, 2% per trade is a very okay risk for me. Again, that's completely up to you. Don't take that as financial advice or as advice on how much you should risk. For me, it's fine. With that being the parameters we're using and with getting 60 trades per month, we have now created a trading plan coming all the way back here that's making 288% per year. Tell me that's not an incredible return. That's the whole point of this video, is to show you again, don't need the unicorn of trading strategies in order to be a successful and even an elite trader in the Forex market. Just use this formula you've been taught today. Take and write this formula down and make sure that every strategy you test, you use this formula. You can then decide to test smaller time frames to increase frequency. You can decide to add risk or subtract risk depending on your risk tolerance, while keeping the strategy and the parameters of the strategy exactly the same. I hope this has been helpful. Again, make sure you write down this formula. It is an elementary formula at best, very simple formula, but it's something that I've used my entire trading career to help me turn mediocre strategies into extremely profitable ones. I hope it's been able to do the same thing for you. Again, subscribe, hit that like button. We're now going to move on to the real charts. We're going to look at the charts. I'm going to discuss with you the top 5 major pairs and what I'm expecting out of them, along with share with you what our predictions from last week have done so far on these top 5 major pairs. Let's jump right into that. All right, guys, so here we are on the charts, and one of the major predictions we had last week was actually on this euro-dollar pair. Let me take it out to the daily chart. What we said about this pair is that we were coming down into a very important level of structure right here. This level of structure has been known to push the market around multiple times in the past, as you can see in through here. So coming down into this level, I did expect some type of major bounce from it, and that's exactly what we got. In this one green candle, we pushed down to the bottom of our zone, along with back up to our next zone, the zone at 1.1189, a little bit lower than what we predicted last week, but nonetheless, we got up right at our zone, and the market pushed back down, back into what? This same zone once more. Now we're seeing a little bit of a rise. Now, the question I always get asked, and what I always want to try to do with these predictions, is give you a practical application to when to use them, how to use them, so on and so forth. But in this specific case, I can't really do anything with the market right now. Now, if we were back down in here and I didn't get a trade opportunity here, actually, I think I had a double bottom that I was going to trade in here, but just didn't see the charts in time. So I didn't actually place a trade. But what I'm not going to do is take and say, okay, well, we're in the middle of nowhere. Now I want to place a trade. If we get back up to the 1.1189 level and in this zone, that is definitely a place I'll look for possible shorting opportunities at this point in the market on the euro dollar. And if we break below this little box, this little area that we have, it's absolutely a place I'll look for a pullback up into for possible shorting trades. But as of right now, not really looking for a trade on the euro dollar. The predictions from last week did work out really well though, and because of that, I'm going to show you a clip of that right now. If that happens, I'm looking at the euro dollar being in a downtrend. With that being the case, I'm looking for possible support as a counter trend play at this previously multiple time tested level of support. We're looking at around 1.1127. That's an area I'll be looking at, and the area may look more like this for a possible counter trend bounce to the upside, considering we're in a downtrend right now. In this zone is where I'll be looking for possible counter trend bounces out of the euro dollar. Now, if the euro dollar pulls back up, one of my main places to look for possible trading opportunities in the upwards direction for trend continuation for a move back down, ironically, is if the market pulls back up into the area around 1.192, I'll be looking at that area for possible shorting trades to continue in this downtrend. So if we get a pullback up, I'll be looking in this zone for possible shorting trades. If we continue pushing down or we get a push down after this pullback, the area I'm looking for possible long trades out of is right back here around the 1.1132 area. That's what I'm looking. All right, guys, so welcome back from that clip. The next pair we're going to take a look at is the dollar yen. Last week on the dollar yen, we mentioned that we weren't really looking for anything. The reason for that being that we're just in this period of consolidation right now. We are floating around our resistance level right now. And what I want to see is if this market can possibly break out of this resistance level, pull back into it, and that will be a place I look for possible long opportunities at this moment. A lot of traders may be thinking short trade right here, and that's not a terrible idea. I believe we could see a push down from here. I really do, but I don't have anything in my trading plan that says I can actually take a trade from here. So that's not something I'm looking at for a possible trade. If for some reason we have some kind of huge crash in the dollar or a huge rise in the yen and this market makes it all the way back down to 107 even, that's also a place I'll look for possible trading opportunities to the long side from out of this market. But the real expectation, what I really want to see this week, is a push up, breaks this resistance, pull back into it, and then a continuation of what seems to be this breakout pattern to the upside. So that's the predictions on the dollar yen. Moving on now, the Aussie dollar. Aussie dollar did not do what we wanted it to last week. We had a prediction that we thought the market could possibly rise from this level. Reason being, we have 1, 2, 3 instances where this level was used as support before. In the past, we thought that would be a great opportunity to look for a possible long trade, but the Aussie got weak, the dollar got strong, and what we've seen is just a breakdown of this pair. Now, what we're waiting for at this moment, though, is a possible pullback into the 0.6910 level. Between that and the 0.6927 is going to be an area in this market this week if we pull back into that I'm looking for possible short trades. As of a counter trend trade now, what we're looking at is this zone the market's approaching at this moment between 0.6854 and 0.6831. That's an area I'll look for possible counter trend long trades out of here on the Aussie dollar. Next up, we're looking at the pound dollar. Pound dollar, another good prediction from last week. We did say that we expected this market to continue in this downtrend. We were really hoping, and in order to get a possible trade from this pair, we needed to see a breakdown, something like to here, that closes below this level, and we wanted to see a pullback up because my play was going to be a trade, a short trade, trend continuation from this zone here. Unfortunately, we didn't get that pullback, no opportunity to get a trade. We have now, though, pulled back into this level of support. I'm not really looking for a trade from here. It is a nice level, but what an even nicer level is, and what I'm really expecting from this market, is to push down to this level eventually. Do I think we're going to bounce from this level right here? Considering the factors, and let's do a practical application of this. When the market's been pushing down this far, this long, right? The pound has been weak as hell. And we've now come to, after being weak as hell for a very long time, a level of prominent support. Normally we do see a pretty nice bounce. Now, this bounce has an opportunity and possibility to come all the way back up to the 1.24 level. Do I think it's going to with this much momentum? Probably not. If we do, this will be an area in the market around 1.24, a little bit lower than that I look for possible shorting opportunities. Also, if we get any kind of pullback here, during that pullback, I'm going to be looking for shorting opportunities because I think this market's going to make it down to 1.2040 before we see any type of reversal out of the pound. And now, again, because of that, if this market does make it all the way down to 1.2040 without giving any kind of pullback, that's an area I'll look for possible counter trend bounces out of the pound dollar. I have been talking fast and a lot, and geez, I am tired of my mouth being this dry. Holy crap. I got to get some water, maybe a cup of coffee. Maybe I probably don't need any more coffee at this point. I'm talking very fast. On the dollar Swiss, here we are. Jumping back on topic, on the dollar Swiss, we're looking at the same thing we were looking at last week, which is I want to see this market break out up to the 1.0 level. That's a level I'll look for possible shorting opportunities out of the dollar Swiss. That's all I'm looking for on this pair. That's all I'm looking for on the top 5 major pairs. If you enjoyed this video, then it would be a great help to me and to the trading channel in general if you would click that like button, comment below with your favorite part, how it helped. Also, click that subscribe button to be alerted when we come out with content like this each and every week. If you want to further your Forex education in ways that we don't really include here on YouTube, some more advanced structured training, more advanced strategies, and more advanced discipline and risk management techniques, then we have the EAP Training Program listed below, the Pro Trader Report listed below if you want to get into one of our smaller programs, and also we have a free training listed below that will give you everything you need in order to trade reversals. All of that is listed below, so to learn more about it, all you gotta do is click the links in the description. Until next time, guys, I will catch my breath now and say good luck, trade green, and I'll talk to you soon.